Welcome to Coffee and Crypto with Lee and Jimmie. I am Lee Reiners, joined as always by Jimmie Lenz. Happy New Year, Jimmie.
Happy New Year, Lee. This is first show of the year, of the new year. I think we're starting our third or fourth year now of the podcast. It's
time flies, right?
We started it around right before we started the conferences. And hey, speaking of conferences, coming up in just a few weeks, I am super jazzed about this this year.
Less than a month. Right?
Less than a month.
So we still have a few seats available. So for all you procrastinators out there, get on it, right?
Although I think all the academic seats are taken. So if you're an academic, man,
tough.
You sat on your hands too long, buddy.
Exactly. Procrastinating. No, I know how that works. Yeah, super excited, obviously, for Digital Assets at Duke. I think it's going to be our best one yet. We just have fantastic speakers representing a diverse mix of firms, crypto-native firms,
really
TradFi firms. But it's really the big names, in this space. It's Coinbase, it's Circle, right? It's Stripe, it's JP Morgan,
JP Morgan,
DTCC. Right.
It's Fidelity. I mean, these are the players in the space.
We got the players.
I'm really excited to see because so much of this has been driven over the past year by policy. I mean, some of the policy guys and some of the law firms, these are like big law firms in the space that are not only coming to the concert but actually are sponsoring the conference. I mean, it's a who's who, and it is, but beyond that, these are the people who are doing this every day. I'm really excited to hear them, and you don't hear me say that about policy guys a lot, but given everything that's happened in the past year and how focused it's been on change in regulation, change in policy. I mean, we're going to talk about a couple of policy things today. That's been a huge driver. I think hand in hand with innovation. I mean, it's been huge.
Well, maybe that's a good jumping off point for today's agenda, Jimmie, right?
I think because
the first topic is a policy topic. So next week,
policy and business.
Policy and business always, and they're related, right? And that's what we talk about at the conference. So next week is going to be, at this point, now things are obviously subject to change as it happens on Capitol Hill.
Yep.
But the long-awaited markup of the crypto market structure bill is going to be happening next week in the Senate Banking Committee, and it looks as though there will also be a markup in the Senate Ag Committee. Okay.
Yep.
So, these are things that have been teased for quite a while. I know Senator Tim Scott, chair of the Banking Committee, wanted to get this done before the end of the year. It didn't happen. There's been some disagreements, let's just put it that way, from Democrats and Republicans on this issue. So I'm not sure if those have been smoothed over. It doesn't sound as like they have, but nonetheless, they are proceeding with the markup because the legislative calendar this year, Jimmie, is rapidly shrinking, right? Because we have to fund the government. Thankfully, it doesn't look like there'll be another government shutdown.
I was going to say, hopefully that goes
hopefully not, but that's
much more smoothly than last time around.
and then when you blink, you're going to be in midterm campaign season.
Yeah,
right? and kind of nothing really happens legislatively then. So they have a really narrow window to get things done, and the timing, frankly, couldn't be better for us in the conference, right? Because look, even if it passes out of committees, right, there's still, obviously needs to go to, the bills need to combine. There needs to be a full Senate floor vote, and then it'll have to go to the House, right? So by the time our conference comes around, we're still going to be, kind of in early stages, if you will, right? So it'll give us a chance to talk about, the substance of the bill. Presumably there'll be one that have passed out of committee then, and kind of the prospects going forward. The big fight, Jimmie, as you know, and we've talked about in the past, is the so-called payment on interest loophole.
Yeah.
Right.
Yeah. I mean, this has been coming up, time and time again. We're seeing different constituencies raise this, but primarily it's been, kind of my friends on the small banking side. The community banks are up in arms, as they should be. This was one. I think, unintended consequences. People do these things, and there are unintended consequences always. Every law, every bill, there are things that happen that you just don't expect, or you don't think they're going to have the gravity that they do.
Yeah.
And this loophole, though, is pretty significant.
Yeah. And I think, our listeners who are crypto savvy know what we're talking about. But for those of you who don't, the Genius Act, right, which passed over the summer and created a federal regulatory framework for stablecoins, prohibits stablecoin issuers from paying interest or yield to holders of their stablecoins. But it does not, given the plain language of the statute, prohibit third parties. So exchanges, for instance, it does not explicitly say they cannot pay interest, yield, rewards, sort of whatever term you want to use. And let's be honest, Jimmie, I think you and I would agree, rewards are interest.
Rewards are interesting. And you and I talked about this a year ago.
Yeah,
we said this is what's going to happen.
Yeah,
and
so
it's come to pass.
Yeah, and so I think the most notable example, of course, is Coinbase will offers customers a reward based upon USDC that customers hold on Coinbase. So that is the big fight right now, and it's really, really ramped up. So last week, Jimmie, the American Bankers Association, and there's a number of different trade groups representing the banking industry.
There are.
There's some that are for big banks, some for community banks. The ABA kind of represents the broadest constituency, really. It represents kind of the interest of all banks. And so when they kind of come out forcefully on an issue, I think it's really indicative of where the banking industry as a whole stands. And so Rob Nichols, who is the president of the ABA, sent out a blast email to all members, right? So to all banks throughout the country saying, hey guys, this payment on interest loophole is a big problem. You need to be engaged in the fight, right?
Yeah.
We need you banks all across the country. Contact your local representative, contact your senator, let them know, right, that this loophole needs to be closed in the market structure bill, right? And that's a pretty big move, right? That's a pretty big move. It doesn't happen all the time.
But don't you think, that's very reflective of something that, we talked about, that, a lot of people said, okay, well, the stablecoin thing's going to come out in the Genius Act, but that's not going to really make that big of a difference. And then all of a sudden they saw that it made a huge difference because we're seeing a lot of money flow into stablecoins. Right. I think stablecoins are becoming what the industry thought they would. They're becoming a de facto currency, and people are, because of the liquidity, because it's tied to the USD, people are using these all over the world, not just here in the United States too. We should say that this is being used all over the world. And when the Genius Bill passed, I think a lot of people took a wait and see approach, but all of a sudden they saw a lot of cash flowing into stablecoins, and that cash otherwise will be sitting where? As bank deposits. In most cases, not 100%, but 99% of the cases, it would be sitting as bank deposits.
Yeah, that's sort of my hypothesis as well. I still think it's sort of too early to definitively state where that is coming from. Look, we've obviously seen some pretty aggressive estimates in terms of how stablecoins will grow, right? I think, what was it? The Treasury's, Treasury Advisory Committee, Borrowing Advisory Committee said like 4 trillion. It was crazy.
It was several $trillion.
Several trillion,
in the next few years. Yeah.
So look,
but the BIS said the same thing. The BIS numbers were almost exactly the same.
Maybe a little less, but so the question then, of course, is like, where is that growth going to come from, and then what are the downstream consequences, right? Because if it's coming from the banking sector, if it's coming out of deposits into stable coins, and that is going to limit banks' ability then to provide credit, right? Because obviously, deposits fund loans. And so that is kind of the main argument. Both sides here are, predictably falling into their, narrative lines of attack, I guess. And I think there's an element of truth to what both sides are saying. So on the crypto side, they are essentially saying, look, these are entrenched incumbents just trying to protect their moat, right? And customers deserve to earn interest, and if they were so concerned about this, they could pay more on savings accounts and checking accounts. So this is just them trying to keep their stranglehold on low cost funding and deny customers the ability to earn more yield or interest on their cash. And on the bank side, it is essentially the point that we made earlier. Where like, look, loans fund or deposits fund loans to the real economy. Um, right, that these stablecoin issuers are effectively wanting to become banks, and if that's true, they should be subject to bank-like
Right.
regulation. This is sort of an uneven playing field. Um, and I don't know where obviously the Senate is going to come out on this because look, both sides are very politically powerful and have donated a lot of money over the years to, Republicans and
Well, I think they
Democrats.
both. I think they both have an argument too, right? I mean,
Yeah.
we certainly don't want to drain deposits off of institutions that are involved in fractional banking and making loans of all different kinds. At the same time, we don't want to deny individuals or institutions the opportunity to have as much yield as they possibly can. Uh,
Hmm.
there was, this is we're in an environment now, a fairly low interest rate environment, and people are, I would say, grabbing for yield any place they can. There was a note that came out yesterday, the president asking Fannie and Freddie to buy more
Yeah.
home mortgages to
Yeah.
try to push down mortgage
Mortgage
rates even
rates.
further.
Yep.
Well, the result of that's going to be lower yield, and people are
Hmm.
going to be that much more desperate at the end of the day for yield. And so I think both sides have good arguments. It'll
Yeah.
be interesting to see because if they close the loophole, do we start to see more fractional or more tokenized deposits that pay higher rates? Do
Yeah.
we see more tokenized money market funds that allow? So I think what the banks are fighting for here and what they're asking for here. I think that box has already been opened. I think they need to come up with a new tack, not just, well, this is going to drain deposits, because now that people know that individuals and institutions will switch, they will do, if it's not too terribly difficult and they feel like it's safe, they
Hmm.
will chase yield to some extent.
Yeah.
I think tokenized money market funds and tokenized deposits will be where they end up, don't you?
Yeah. Again, it's really hard to predict, and there's a lot of switching costs. Consumer payment behavior. We talked about this a lot. Actually, is very, very sticky.
Yeah.
Um, Now, look, if it's a case where because under Genius, banks can establish subsidiaries that are stablecoin issuers, right?
Mhm.
So look, if it's the case where I can sort of, log on to like JP Morgan, whatever like that, and it's pretty simple for me, on my phone or, on my laptop to kind of move between a JP sponsored stablecoin that offers rewards and a deposit, like then I think, yeah, maybe you'll see some outflows if stablecoins are allowed to pay rewards. Um, but I don't know. I'm just kind of skeptical in the US at least that you're going to see this sort of mass adoption of stablecoins. And I honestly think that the crypto industries sort of how they're digging their heels in on this is reflective of their probably deep down belief that in fact US consumers are not going to really be using stablecoins for payments or would otherwise, right? Absent this rewards thing. It's kind of like your lobbying is indicative of your true beliefs a little bit. Now, the same obviously could be thrown back at the banking industry, right?
Yeah.
So I don't, look, consumers have options right now. Okay. You can get a you can go to Schwab, you can go to whatever, E-Trade, you can get a money market fund, right? It's not as if it's like your options are either like, a deposit or a stable coin,
Right.
like
Right.
there's other ways to pick up yield. So it's not as if I feel as though I am lacking in opportunities to pick up, a little extra yield
Right.
on my spare cash. So, but anyway, look, this is the fight. This is the biggest fight. And I think, and we saw Patrick Witt, who has replaced Bo Hines as President Trump's sort of chief crypto advisor. I forget his official title. He weighed in this week on X, basically on behalf of the crypto industry and saying, look, this whole payment on rewards thing is here to stay,
Yeah.
basically. So we know where the White House stands. I guess
So
that was a definitive stance. So we'll see.
so I've been looking at this a lot. The question, and so my question is, so with all of this, known, with what we've seen, the behaviors that we've seen, and what what's happened as far as the movement to stable coins and things like that,
Yeah.
does the Fed and other provincial regulators start to consider stablecoins differently than they have in the past as far as their treatment, inside of financial institutions? Do they start to treat it maybe different as a HQLA or as cash-like or
Yeah.
something along those lines, so that stablecoins start to occupy maybe a little bit different space inside of banks? What do you
Yeah,
think?
that's a good question. I mean, so you're looking at it from a from a non-issuer standpoint, right? Because
Right.
if it's a if yeah, so if you just are a bank and you hold stablecoins on the on balance sheet,
Right now, you
does
have to
that
hold
count as
cash against it. You have to hold a reserve against it.
yeah? So it
But
doesn't count as it. I think it would count as HQLA. Have they?
no,
Yeah,
it
that's a good
doesn't.
question.
It doesn't. I checked. It is not considered HQLA.
Really, for
Yeah.
liquidity coverage ratio purposes.
Right.
Yeah, so I think that would probably change. I mean, at the end of the day, if the assets backing the stablecoin count as HQLA, I don't see how you could argue that the stablecoin
Because it's a
itself.
the way that the reasoning I read behind it was it's because they're a claim on those assets. They're not the assets themselves. So
Hmm.
even if you did a government treasury stablecoin and that's the only thing they can buy, it's still a claim on those. It's not the actual holding the treasuries. That's why treasuries are considered HQLA, but
Well,
claims against
a treasury is a claim on the U.S.
on
federal
the U.S.
government.
government. I know, I know. Hey, that's that. I'm just telling you, this was the reasoning because I went
Yeah,
and looked into this in a fair amount of detail because I'm very interested in do we start thinking of stable coins as a different, more cash like than they have in the past?
yeah, that's a good question. I think that's a nice segue to our next story, Jimmy, which is Moody's. Okay, so Moody's released their digital economy outlook, okay,
Right,
for 2026. And they said in there that stable coins have become core market plumbing. Okay.
yeah,
And Moody, the rating agencies, they are not prone to hyperbole, right? Or at least
they're pretty conservative places.
post 2008 at least. um, and right. So I thought that was pretty telling. Okay. So in the report that Moody's published this past Monday, they said that stablecoins processed about 87% more settlement volume in 2025 than the year before, reaching 9 trillion in activity based on industry estimates of on-chain transactions, right, rather than
Right,
purely bank-to-bank flows. So they went on to say fiat-backed stablecoins and tokenized deposits are evolving into digital cash for
yeah,
liquidity management, to your point, right?
yeah,
Collateral movements and settlements. So, they say, look, this is not without risk, of course, right? There are issues with oracles and smart contracts and whatnot, but clearly the trend is moving in stablecoins as cash management vehicles, along with tokenized deposits. And that brings me to
right,
the next story, Jimmy, before I turn it over to you for your thoughts.
yeah.
JP Morgan and JPM Coin. Now we are going to be hearing from Zach Chestnut,
We
who
are
is at JP Morgan working on this project. So JP Morgan's Connexus division is launching JPM Coin on the Canton network. Okay.
right.
Now, previously we've talked about this. They initially launched on Base, right? Coinbase's Ethereum
Yep.
layer 2. But now they are launching on a layer 1, Canton. Layer 1, this Canton is backed by a number
Yeah,
of
it's a bunch.
TradFi
It's a
firms.
whole. It's like a mutually owned by all the big financial
Exactly.
players. Yeah,
And I think the premise behind Canton was to allow for institutional grade privacy, right? What
yeah,
they call configurable privacy. So I think this is a pretty big deal. Anytime JP Morgan does something, I think we should take notice, right? Because
absolutely.
they're the biggest bank in the world and they don't just, sort of rush into things without thinking it through thoroughly. And so again, I think with JP Morgan, right, the goal is to have for their standpoint an alternative to stablecoins for institutional clients that can be accessed via a wallet at Chase, and then they'd be able to transfer and redeem JPM near instantly, right?
Yep.
JPM dollar.
They will be able to. I think it's a. I mean, it's an interesting move. Obviously, JPM's been at the front of the curve with stablecoins and tokenized deposits. I mean, they've been in this space for a long time. I mean, they formed a partnership with Consensus. Gosh, has to be like 6 or 7, 8 years ago. I mean,
Yeah.
it was a long time. And then they spun off and they had, they formed their own company, Connexus now.
Yep.
Which, by the way, we have a couple of fintech grads, Duke fintech
Nice.
grads work there, which is very
All
cool.
right. Shout out to Duke FinTech alums.
Yeah, they're working in Connexus, which is very cool. But I think that when we're looking at this, J.P. Morgan is going to be kind of the bellwether right now.
Yeah.
They do seem to be a leader. They had announced that they're using Ethereum and Bitcoin as collateral for loans now. They are definitely, I think, pushing the envelope a little bit. But I mean, folks, these things are coming to pass and they're being adopted quickly. So I would say, if you want to, and people ask me all the time, oh, where should I look? It's like, look at JP Morgan. If you want to see what traditional banks are going to be doing, look at JP Morgan, because they just seem to be at the front of the curve.
Well, yeah, that's a great point. I mean,
and
that's
they're
kind of
taking chances.
Well, I don't know if it's front of the curve. I mean, maybe it's middle of the curve. Like I don't think they necessarily led on anything, but that's sort of it's the fast follower approach, right?
Very fast. Yeah. And with size.
Yeah. And so that's kind of a helpful heuristic. I mean, I use that too, Jimmie, which is because there's so much going on. You go to, CoinDesk or, any of these sort of crypto news publications. And like on any given day, there's like anywhere from like 3 to 6 new stablecoin product announcements, and this firm is getting in, and so it's really hard to kind of, stay on top of it, but also sort of put it into a broader perspective, right? And that's why I kind of look to a handful of firms to sort of gauge, okay, is there some credibility to this, right?
Yeah.
And JP Morgan is one of those firms, right? If they're doing it, I'm saying, okay, well, there's something to this, right?
They're probably a leader in the space. I mean, I think in 2026, we're going to see, because we do have more people holding stablecoins, we do have more people holding crypto. I think we are going to see more lending based on these assets. Reg T and Reg U, I could easily see them carving out spots like they do for equities and debt, release amounts and those kinds of things. I could easily see that happen because people are starting to integrate these things. I mean, we said last year, we mentioned on the last show of last year, we talked about, the allocation now that a lot of retail brokerage firms, the wirehouses, are providing their customers to, crypto assets. And with these becoming more and more and more accepted, I mean, this is collateral that they're going to have to use in one form or another. And so as they, as we start seeing more and more of this show up, I could easily see this being it starts to get very normalized, this being used as collateral for loans.
Okay, well, let me ask you another stablecoin related question.
Okay.
Moving on to our next story. Wyoming.
Yeah.
Okay, the great state of Wyoming. They, earlier this week, launched the first fiat-backed, fully reserved stablecoin to be issued by a public entity in the U.S. So the Frontier stable token is now available on the Kraken cryptocurrency exchange. Kraken is domiciled in Wyoming, and holds the Wyoming Special Purpose Depository Institution Charter. Users can purchase the stable token on the Solana blockchain and transfer to additional blockchains using the Stargate platform. And the Frontier token is available on Arbitrum, Avalanche Base, Ethereum, Optimism, Polygon, and Solana. My take is this is a proverbial nothing burger. I don't see this going anywhere. This is a clever bit of branding. Wyoming is going to use the proceeds to help fund schools, and that's an admirable thing. I guess it's probably better than the lottery from a social utility perspective, but I just don't see much happening from this, Jimmie. But I guess it's worth talking about. What are your thoughts?
Yeah, I'm kind of of the same mind. I mean, it returns the interest to the state, and the state gets to use the interest. I mean, what's the driver about these things? I can't figure out. Yeah, it's for institutional and individual use, but what's the driver to buy these things? I can't really figure out. I mean, you want to support your state, and I get that, but
Yeah.
Wyoming's a pretty small state in the big scheme of things as far as population goes. And so I just don't see. I think it's, as you said, clever bit of branding. It's funny though. I mean, Wyoming was on the forefront a couple of years ago. We saw, some banks being headquartered there. We saw Kraken there. We saw, some other people have, made it a very, very loud move to Wyoming to do different things. And then they've kind of faded in a pretty big way. Now, I know, the governor there, I know Caitlin Long would not say that, but it seems like they've kind of faded out in the past year or so, doesn't it?
I don't know about that. I mean, they were early. Look, you had kind of in the, about 10 years or so ago, kind of crypto advocates sort of fan out across the country and try to establish a toehold in various, state capitals and
Right.
say, hey, do all these things to make, your state the crypto capital of the US, whatever like that. And, they found some willing legislators. I mean, in most states, being a state legislator is a part-time job. So it's not as if you're necessarily going to, know any better. Someone says, hey, this is, you do this and it's going to create all these jobs and tax revenue and whatnot. So, they found a willing audience there in Wyoming, and they've gotten some fairly significant policy wins. But I think just because you roll out sort of a favorable regulatory environment for, let's face it, what's still a niche industry. I mean, it's growing, but it's still niche in the big picture. It's not going to like lead to this like, mass inflow of firms to Wyoming. I mean, people, I mean,
I
it's
think
a
they were
beautiful
hoping
state.
it would, but it
I think
hasn't
they're
panned
hoping
out
it
that way.
would,
Yeah.
but if Wyoming was not, a marquee destination for corporations and startups prior to all this stuff, I don't think this is going to change that.
No,
Anyway, nothing.
doesn't
I mean,
seem to be.
I don't want anyone from Wyoming to be upset and send us hate mail or anything like that,
No,
right?
no, no. I just
Um,
don't see the driver behind. I mean, I'm looking at this as a pure business thing. What's the driver for buying this thing?
yeah, yeah. Okay, well, let's move on to the next stablecoin related story.
We have a
And
lot of
the
stablecoin stuff going on.
stablecoin stuff. Well, it's hot, and we're going to do a
Yeah.
stablecoin panel, and we're going to have Circle and Tron and Stellar on that one. But and this is related to President Trump's crypto grift, which seemingly knows no bounds.
Yeah.
But World Liberty Financial is officially filed to launch World Liberty Trust Company, which they want to be a OCC chartered national trust company. Now,
Right.
again, once the Genius Act was signed into law, we saw a flood of applications to the
Yes.
OCC to create national trust banks
Hmm.
to be stablecoin issuers or hold stablecoin reserves. There wasn't a lot of, there's a public portion and there's a full application. The public only sees a little bit, so it's
Right.
still not entirely clear what the aims are. But it was quickly evident, Jimmie, that this was sort of the preferred. The industry has sort of settled on this charter in particular as sort of the preferred method
Yeah.
of being Genius compliant, right? For a variety of reasons. I think, when you hold a national trust charter, you can custody your own reserves.
Right.
You have better chance of getting access to a Fed master account. So, and then ultimately, if you want to grow beyond a certain size, you need to be OCC supervised or federally supervised anyway. And so you might as well start out of the gate being OCC supervised. So there's a lot of
Yeah.
reasons why intuitively it makes sense. This has been a big fight, obviously, with the banking industry saying, look, the whole purpose of a trust charter is to engage in traditional trust fiduciary activities, right?
Right.
And these stablecoin firms, they're trying to expand the bounds of what a trust company is allowed to do, is their argument. It's a big fight, but the OCC has approved a number of these.
Yeah. Yeah.
And
Including,
honestly,
a
like with
number of
this,
participants.
yeah, a
Of
number,
yeah.
Ripple, Circle, you
Fidelity
name it.
Digital Assets.
Yeah, there's been 6 or so.
Paxos.
Circle, Ripple, Fidelity, Digital Assets, Fidelity Digital Assets, BitGo, and Paxos have already received
Yeah.
national trust charters from the OCC. And now World Liberty Financial, who has the governance token WLFI as well as USD1, the stablecoin. And we've talked about, the ties with Binance and the
Right.
UAE with that stablecoin. Um, look, Jimmie, this application could have been written in crayon and it's going
Yeah.
to get approved. All right. I can't imagine a world in which the comptroller of the currency is going to say no to an application from a business that President Trump is an investor in or is an owner in.
Yeah.
That's just the world we live in. So there you go.
But
Using the
the
power
fact
of the
that they've
presidency to
already
profit here.
the fact they've already approved a number of these, I think this is, in particular in the, I think for custody and things like that, because for a bank to custody, you have to have a special license.
Hmm.
And so
Yeah.
every bank can't custody until they get this. Uh, the idea around custodying the assets is, I think, going to become more and more important over the next year or two. I think that's going to
Mm.
be a really big deal, and it's a boring thing, and I know it's a boring thing, but it's going to, what it does is it makes it easier. It makes it easier to facilitate different things. If all of a sudden I can
Yeah.
custody assets, I mean, why do we go to brokerage firms? Because they can custody your assets, and it makes it a hell of a lot
Hmm.
easier.
Yeah.
Could you, I mean, I don't even know, I don't think you can buy shares directly anymore, but you used to be able to buy shares directly from companies, but you can't do that
Yeah.
anymore because, central books and things like that. And so I think that, some of these more boring services, and I think this is why people need to, our very first story today about around the market structure build, people need to be paying attention to it. The small things turn out to be big things at
Yes.
the
That's
end
how it
of the
works.
day. And I think as anybody who is involved in financial services knows, or even peripherally watches it, those small things can really be kind of blown up, and they can blow things up. So
Yeah.
keep an eye on these kinds of things.
Well,
These small
the clever
things.
lawyers will identify those small things that are someone's opportunities, right? Someone's margin.
Watch
Um,
the footnotes. Watch the
yeah. So
footnotes.
I got two more stories, Jimmy. We're gonna go a little longer today, if that's okay. Just it's been 3 weeks since
It
we've
has
done
been a
a
while.
show. Yeah, it's been
Yeah.
a while, so we got a lot to talk about. So two more stories. One, returning to an element of market structure, but then sort of related ongoing efforts at the SEC to sort of accommodate tokenization and digital asset technology. And it relates to Citadel. Okay, now
Okay.
Citadel has really just kind of gotten into the mix here, and and I'm thankful, right? It's good to
Hmm.
finally have. I think in the past, I never would have thought that I'd be allied with Citadel on any issue, but crypto makes for strange bedfellows, and so now that we're getting closer to the end zone, if you will, of market structure and some of what Paul Atkins has in mind with the so-called innovation exemption, you're seeing TradFi firms kind of weigh in because they realize, oh
Yeah.
shit, like we better make our voices heard here. And so Citadel has really gotten, into a bit of a tiff, if you will, with the crypto industry. And they have sent several letters to the SEC's crypto task force on tokenization and DeFi trading protocols. And I think these are sensible letters that they've sent. I've read them all. And so the most recent from December 31st was in response to a letter from the DeFi Education Fund, which in turn was a response to an earlier letter Citadel had sent. But basically, what Citadel is saying here, because Atkins has talked about this tokenization exemption, right? This
Yeah.
innovation exemption. Okay. And what Citadel has said is basically three things, right? That the SEC should identify whether any firms involved in DeFi or tokenization meet the statutory definition of an exchange, broker, or dealer,
Right.
right? And then apply the law accordingly. Uh, they also say that the SEC should refrain from granting broad exemptive relief from those longstanding statutory definitions, and that finally, rather than do an innovation exemption or whatever broad exemption Paul Atkins has in mind, the SEC should conduct a rule by rule analysis to identify impediments to using tokenization and address those through public notice and comment rulemaking, not through declarations or exemptions. So
Right.
I think it's all pretty sensible. Now, the crypto industry has really dug their heels in, Jimmie, on DeFi and this notion that if a protocol or a platform or whatever term you want to use never takes custody of customer property, then somehow that means they shouldn't have to comply with any rules or regulations. And Citadel has correctly pointed out that the Exchange Act does not. That's not what is required in the Exchange Act, right?
Right,
That
because
even if
exchanges never take,
yeah, like the
yeah,
the
they
Nasdaq
never
does
hold
not.
they
Yeah,
don't custody the
Nasdaq just never
assets.
takes possession of anything,
Right.
right? I mean, it's just a matching engine, right? I mean,
Yeah.
it's basically what it is. So, um, so I think it's pretty sensible. And my sense is from talking to some folks on Capitol Hill that Citadel's arguments are carrying some weight amongst folks right now. So I don't. I'm sure we're going to talk about this. We don't have anyone from Citadel at the conference, Jimmie, but
No.
I'm sure folks. We do have a couple tokenization panels, and I
And we do
suspect
have
this will get brought up.
we do have some folks from other large firms that are very similar at the conference. People from Virtu are going to be at the conference, for instance, and I think that you're right. There does seem to be a there seems to be this departure, and maybe a press sometimes of moving a little bit too fast. But
Mm-hmm.
I do understand where they're coming from. This is I think when you start tokenizing equities and things like that, and I've said before, I really don't get 100% for an existing equity the value that you derive from tokenizing it. But
Yeah.
be that as it may, all of a sudden it changes the landscape a little bit. In particular for firms like giant market making firms like a Citadel.
Yeah.
I could see it definitely being an impediment to their business. I think
Oh, of course.
pardon?
Yeah, of course. I mean, they're not
Yeah.
writing letters to the SEC on behalf of the little investor
No,
out there. Let's
no.
be honest. Yeah.
No, they're representing themselves. I think
Doesn't
that
mean they're wrong.
absolutely does not mean they're wrong. I think their suggestion that they go rule by rule. I mean, you and I both know our grandkids would be reading about that. I mean, can you imagine if they actually do that? I mean, we still have stuff from the financial crisis that was enacted that still hasn't been put into place.
Well, I think and that's a good point, Jimmie, and I agree with you there. I mean, the way I interpret that argument though is saying, look, okay, Atkins has talked a lot about tokenization, the benefits of tokenization, but no one from the SEC has articulated what are the specific rules and regulations in place now that are impeding, right, the use of tokenization in a way that will fulfill the benefits that you're claiming are there, right? I think that would be helpful if they could just lay it out and say, look, and I think Atkins has talked a little bit about it in the context of Reg NMS and the so-called pass-through rule. But it would just be helpful if they could just put out, a document that says, look, these are the existing kind of, market structure rules that we think are not compatible with the complete vision of tokenization.
Right.
And, and then go from there.
I think that would be a huge undertaking,
it just feels as though like the outcome is like they're starting from what they want, which is no rules to apply for tokenization with, and it's like, well, that's not the right way to approach
that's not the
it
right
here.
approach.
Well, speaking of tokenization, Jimmie, DTCC, right? Big news
DTCC.
Right before the holidays. And this happened after our last episode, so we didn't get a chance to talk about it.
Yep.
And we will, of course, at the conference because
DTCC
is a sponsor, and we're gonna do a little session on this because I think it is such a big development here. But for those of you who don't know, shortly before the end of the year, DTCC obtained no action letter from the SEC's Division of Trading and Markets, allowing a new securities tokenization service. Now, this is a pilot. Okay, they're calling it the preliminary base version of its tokenization program. So, Jimmie, let me just get your quick thoughts on it because I actually have the full letter in front of me, and I thought it'd be helpful to walk through a little bit in terms of how it worked. But I just want to kind of get your quick initial reactions here.
Initial reaction is I'm really, really glad to see the DTCC step up and do this. I think that for people that don't realize what the DTCC is, and probably there are a few listeners that don't, this is the agency that basically clears and settles all equities, most bonds, and other a good number of derivatives in the U.S., but not only in the U.S., in a number of other countries. And
Hmm.
so not only do they clear and settle, but they also guarantee delivery through a kind of an insurance mechanism that they run.
Yeah.
And so the DTCC is the place. So if you wonder where securities are actually held, all securities basically are held at the DTCC, and brokerage firms have claims on those. They keep all the electronic records. I mean, this is the place that knows where everything goes. And so,
Hmm.
but because of that, they have basically a lock on the market, right? They have a monopoly on being able to clear and settle securities in the United States. And there have been a couple of
Yeah.
upstarts that have tried to to do the same thing, but that just hasn't gone through.
Yeah.
And so I applaud them for moving forward. I'll put this out there. They're a very big sponsor of the graduate program that I lead at Duke.
Hmm.
They have been a very big sponsor of the conference. And
Yep.
so they have been looking at this and experimenting with different kinds of distributed ledger technology and blockchain technologies for
Hmm.
years. And so to come out with something like, to get this no action letter, I mean, I think it shows that they were very thorough in what they're doing. I think that they
Yeah.
have backed it with significant research. And let's face it, I mean, they've hired and bought a lot of talent.
They have.
So I'm
Well, they have, Tom Sullivan at last year's conference, he was with SocGen Forge, right? And now he's at DTCC, right? So,
right. And he'll be back at the conference this year, I
he'll be
believe.
back at the conference this year.
So, along with another number of others from DTCC. So I thought that I mean, this is one of those things that's kind of quiet and a little bit policy-ish, but this could be one of the more significant things that occur in 2026. I really believe so.
So let me walk through a little bit about how this works, Jimmie, because there's different degrees of tokenization, right? And so I would sort of bucket this into the kind of the mirror token, sort of umbrella, if you will, which is not kind of the tokenization advocates like True Vision is like a digital native, right, security, right? Like one that is issued exclusively on the blockchain, right? And that is sort of the sole record.
Right.
And we're going to talk about that with Aaron Kaplan at the conference from Prometheum, because that's the Prometheum vision. And so they're going to talk about what it takes to get there. So here's how this is going to work, Jimmie. Okay. So the base version here, which is the pilot, okay, would allow DTC participants to elect to have their security entitlements to DTC held securities recorded using distributed ledger technology, okay, rather than exclusive through DTC's current centralized ledger. Because as you said, Jimmie, how it currently works is DTC for equities is the title holder, is the legal holder of the securities, right?
Yep.
And then their customers, which are primarily, Wall Street brokers, right, have a beneficial and economic interest in those securities. And then the brokers then pass on that economic interest to us, right? The end investor here. But DTC is technically the title holder. Okay.
Right.
So any DTC participant wishing to use this new tokenization service, okay, would then register with DTC one or more addresses on an approved blockchain, okay, for the purpose of holding tokens corresponding to these tokenization entitlements. Okay?
Yep.
And then a DTC participant with a registered wallet would be able to instruct DTC to tokenize their security entitlement to certain eligible securities. I think it was Russell 1000. So securities within that are part of the Russell 1000 or ETFs tracking like the S&P 500. And then what it would work is that upon acceptance of the tokenization instruction, DTC would debit the subject securities from the DTC participant's account and credit them to a digital omnibus account an account that is held on DTC's centralized ledger that reflects the sum of all tokenized entitlements held in registered wallets. DTC would then use its own system. They're calling it the factory system, which is software maintained by DTC to mint and deliver to the DTC participant's specific registered wallet a token representing that participant's security entitlement. Okay. And then once they have that token, they can send it to other registered wallets. Okay.
Yep.
So there you go, folks. So basically, DTC will then, if you want to tokenize a security, an eligible security, you let DTC know. Okay. What they will do then is they will give you a token, okay, that represents that security entitlement. They will then debit your account on their traditional ledger, okay, and then they will then have a omnibus account where all the kind of that represent all the tokenized equities that are out there, okay. And that's how it's similar to kind of how a crypto exchange works. So it's a little
Much, yeah.
a little complicated in the mechanics in terms of how it works. And I think the question I have for you, Jimmie, is like, given what I've laid out, is that something that you think market participants will find useful or beneficial, or like what, how will the market respond? Like, what are the advantages to allowing this type of tokenization?
Yeah, so I think that we're going to see some really innovative firms are going to step up first. That's what I see. So think firms that are either coming out with IPOs fairly in the short term. So they want to take advantage of something like this. And I think for other firms, it'll be a little bit of a wait and see
Okay.
what happens. But I think there are a lot of, there are going to be some advantages to doing something like this. One being seen as being an innovator and being the front of the curve type of thing. Will this mean that you get your shares into more hands? Probably. I could see this being a new mechanism to get shares into hands of people that you might not otherwise. So you basically get a wider shareholder distribution, which is what most companies want. They don't want it to be concentrated. And so I do think that by doing this, they will appeal to probably a broader set of possible customers. The other thing that I was interested in knowing is, how are these actually going to be facilitated? Are they going to be facilitated in the same way? Will you open up a regular brokerage account? Will you go through the same sort of mechanisms? Will you, how are they actually? Because I understand how they're going to be tokenized. I understand the blockchain, all that. But is there going to be any difference as far as actually having access to these? Is the access point going to be different? Is it going to be broader? If it's not, if it's going to be exactly the same, it probably has limited appeal then.
Yeah. Well, these are questions that we will have to ask at Digital Assets at Duke.
We will definitely ask those.
All right, Jimmie. Well, we covered a lot of ground today. A lot of fun as always. Again, folks, if you haven't registered for Digital Assets at Duke, make sure you do that ASAP. Okay. Obviously, you can always shoot Jimmie and I an email if you have thoughts or questions. But Jimmie, I hope you have a great weekend, and I look forward to doing this again next week.
Absolutely. Have a good weekend, Lee.